What are the different types of grantor trusts? If you are curious about the various types of grantor trusts and how they can fit into your estate planning, you are in the right place. Understanding these trusts can help you navigate estate tax planning effectively. Let's break down the different types of grantor trusts and their unique features. First, we have the Revocable Living Trust. This is the most common type of grantor trust. The person who creates the trust, known as the grantor, retains full control over the assets in the trust during their lifetime. Since it is revocable, the grantor can change or cancel it whenever they wish. One of the main benefits is that it helps avoid probate, making it easier for assets to pass to beneficiaries after the grantor's death. However, because the grantor maintains control, the assets are not shielded from creditors while the grantor is alive. Next is the Intentionally Defective Grantor Trust, often abbreviated as IDGT. This type of trust is designed to remove assets from the grantor's taxable estate while still treating the grantor as the owner for income tax purposes. This means the grantor pays the income taxes on the trust's earnings, allowing the assets to grow without being reduced by tax payments. IDGTs are particularly useful for transferring appreciating assets, like business interests or real estate, to beneficiaries while minimizing estate and gift tax consequences. Another type is the Grantor Retained Annuity Trust, commonly known as GRAT. In this trust, the grantor retains the right to receive annuity payments for a specified term. If the grantor survives this term, the remaining assets in the trust pass to the beneficiaries without incurring estate tax. GRATs work well for assets expected to appreciate significantly, such as stocks or closely held businesses. The retained annuity interest allows the trust to be treated as a grantor trust for income tax purposes during the annuity term. Then we have the Qualified Personal Residence Trust, often referred to as QPRT. While not always classified strictly as a grantor trust, a QPRT allows the grantor to transfer a personal residence or vacation home out of their estate at a reduced gift tax value. The grantor can live in the residence for a set number of years, after which the property goes to the beneficiaries. During this time, the trust is treated as a grantor trust for income tax purposes. There are also other types of grantor trusts, such as grantor retained unit trusts and certain charitable lead trusts structured as grantor trusts. The key feature of all these trusts is that the grantor retains certain powers or interests that cause the trust's income to be taxed to the grantor rather than the trust itself. In estate planning, grantor trusts provide flexible strategies. By having the trust income taxed to the grantor, the assets can grow without being diminished by taxes. This allows for more efficient wealth transfer to beneficiaries. Irrevocable grantor trusts like IDGTs and GRATs can reduce estate tax exposure while allowing some control for the grantor during their lifetime. Revocable living trusts primarily help avoid probate and manage assets during incapacity, but do not offer asset protection or estate tax benefits while the grantor is alive. The main types of grantor trusts include revocable living trusts, intentionally defective grantor trusts, grantor retained annuity trusts, and qualified personal residence trusts. Each serves distinct roles in managing assets, minimizing taxes, and facilitating wealth transfer in estate planning.